Hello, everyone. Welcome back to another weekly review. So, I just want to remind everyone that I'm in the process of a move, and right now I don't have Wi Fi. So, I'm using my data to chart, and I will be uploading this at a community center most likely tomorrow. Therefore, I can't really stream, and it will be hard for me to always upload. And as I don't know when I'll have Wi-Fi, it could be as soon as next Monday. It may also just take another week. So when I do get Wi-Fi though, I'd like to start streaming a lot more because it is the summer, and I want to take it easy during the summer. I talked about how I was thinking of when I got my accounts on Apex back to break even. I was thinking of, not trading them anymore and just running a top step challenge at the beginning of the week this week, and that way it would just allow me to relax, take the risk off, take the summer sort of off, and just focus on a challenge and get funded with Top Step as well as with Apex. Now, what happened this week? I did not upload the trading session, but I'm going to talk about it in depth on why I took these losses. But this was on my 25K Apex account. I just need to create it, and then this one down here was on my uh my the account I was trading, the 50K account. So they're both in about 400 $500 a drawdown. Um yeah, and no, the other one is 300. The 25K account is $300 drawdown, and then this one is about $500 drawdown. So I decided to stop trading these account for the rest of the summer. I will not be trading any of these account until maybe midway September, October. And I'll figure out what to do with them then. But right now, I'm just trying to get funded with Top Step, and the way I'm approaching this challenge is going for 12, 13 points. Basically, what I did last October when I first saw success, when I first started to see real consistency, was last September when I started to trade. This is known as Cameron's model, but I was only going for 13 points, 12 points, sometimes 11 points, and then 15 point stop loss. So it was a negative RR, but it was a small amount of points. And you'll see the Thursday trades, I was on the right side of the market. My stop placement was just not that great. And it would have been better if I had been more patient, or if I had went for a less amount of points. Um, but this is something that I had been thinking about for a while. Even when I started to do those Apex challenges, I had told myself that when I get funded, I would go back to that model. But for the sake of the challenge, I would just go for as many points as I could feel comfortable with getting. And when I started to get these 30, 40 points, I sort of kind of wanted to keep going on that and got away from the model. So now I'm going back to it. This time, I want to do that model while passing a challenge, right? And so hopefully this challenge is gonna be good. So far, I'm 2-0, and I'm up. As you can see, the 524 $40. Now I won't be talking about this. I won't be showing. I don't know if I'll be showing the trades. I don't know if I'll be showing the P&L. But at the end of the week or whatever, I'd like to show the progress on it, how I'm doing, the statistics. Right now, there's not much to show because there's only 2 trading days, but I'd like to actually go into Top Step X has this really nice breakdown of all your trades and your most profitable days and you know the average trade you're holding, stuff like that. So I'd like to just give me time to do that, and then at the end of the week, kind of update you guys on how that's going. But I don't know if I'll be displaying it every day and being transparent about it. All right, so uh, this is the economic calendar. Now, nothing too crazy. There is unemployment claims and the Powell speech at the beginning of the week. Those are the two kind of big news events that I was looking at. And unemployment claims, we did have more unemployment claims, so it's going to be interesting to see if from here now to September, unemployment does start to go up significantly. the unemployment claims aren't as high as they used to be when the Federal Reserve stopped raising rates in July 2023. So yeah, it'll be really interesting to see how unemployment claims, they come out every week, how they're going to, I think almost every week, how they're going to act, how will they be released from here to September. Yeah, if they keep spiking up, we can expect unemployment to start to go up. If not, then I don't think the Federal Reserve is going to cut. Even though everyone says an 88.2% chance they're going to cut, they're not going to cut if everyone's pricing in a rate cut. Because that gives the effect of a rate cut, right? I've said this for a while, but when the Federal Reserve says they're going to cut or they're thinking of cutting, or they don't say they're going to cut, but if they're talking about how it's possible they might cut, and the media goes out and says that they're going to cut by this date, that's propaganda. And everyone, all the businesses, they're all pricing in that rate cut, pushing up the inflation, giving the need to keep the or taking away the need to cut rates to prop up the economy. Because when they cut rates, it increases spend, it induces spending. People spend more because there's lower rates. They can afford it more. But if you tell everyone you're gonna have a rate cut, people get excited. They're gonna start to spend before that rate cut. That's exactly what's happening. This is Sunday. We have left another down close candle. We are also mid July, which is when we can start to think about slow summer price action. And seasonally, Q2 goes lower and Q3 may initially go higher. With how bullish Q2 was, I'm prepared to see further higher prices in Q3. Right, so seasonally, we're gonna go lower in July, August. If you look at last year, this is exactly what happened. July went up halfway, and then the other half we went down into August and made a low in October. Did a bit of a consolidation at the in September, and then manipulation in October, and it ran up for Santa Claus rally. This is a seasonal tendency. It happens almost every year. Some years are different. Like this year and last year, it was different during May. Price went up. So because the seasonal tendencies were not respected in May and price was very bullish, I want to see if it's going to continue to be bullish here. But it seems like we may have put in a high, and we may actually get that retracement into October. So I'm not considering a bearish order block off the highest up close candle. So I'm talking about this one. I'm looking at this candle up here, and I'm saying, okay, could this be a bearish order block? The reason why I'm not considering it is because there's a consecutive amount of up close candles. That one right there is kind of like midway, but overall there's a consecutive amount of down close candles. So there's still a lot of PD arrays to support price. And I don't try and pick tops. That would be picking a top, right? On the daily chart, I don't pick tops. On the smaller time frames, I do it all the time, but on the daily chart, I don't pick tops. So what I'm doing is I'm waiting for more information. I'm waiting to see if price is going to close beneath this highlighted range in yellow. If it does do that, I know that there's been a change in the state of delivery, and that's an order block. Like this would be the whole order block that's formed that we would then be using in the next weeks after that as resistance. That's what I say here. I will be watching the order flow to see if we invalidate this range. Only then will I want to be bearish. So I'm waiting until that happens to be bearish. The S&P is stronger too, which indicates that if we go lower, we have a condition of NASDAQ leading lower, which is what I wanted in a bear market. There's been times this year before where I'll go back over it at the end of the year. I can't wait for that actually. But I'm gonna highlight, times where I remember there was times where on the daily chart the Dow and the S&P were going lower and the Nasdaq was going higher. And I'm telling myself, people probably think that this is divergence, and that we will. I think actually it happened back here, where the Dow was going much lower, or maybe it was before that. And people might be thinking that's divergence, but the problem is that it's the Dow that's the leading index, and that's not the case. I remember well in 2023 mentorship, ICT was talking about how if we turn to a bearish market, you're gonna want to see the Nasdaq go and be the leader. right? So the Nasdaq should go and lead the Dow to go lower, and this is the perfect condition there, right? The S&P is still higher, stronger. The Nasdaq's leading. You can see the body-to-body S&P, Nasdaq closing way below the S&P. Okay, and on every end, lower bodies at the highs and lower bodies at the low. So everything's lower in the Nasdaq, while the S&P is still a bit stronger. Now, I'm talking about the current PD raise on the hourly chart. There was this fair value gap, which supported, it's a 4-hour fair value gap, and it supported price quite a bit at the beginning of the week. And there was the hourly reclaimed order block that was also watching consequent approaching this gap. Okay. Right now, I'm not framing lower prices. I'm framing maybe a rebalancing of this range, but we could also dip down to these lows because there's relative equal lows back here. If you look at maybe a better picture, I don't know if I have a better picture, but you can see that daily chart, this low there, that's these lows, and it's creating relative equal lows. So I know there's liquidity lower at sell side. I don't know if we're gonna go down there first before going to buy side. All right, so either we would be really quick to get down beneath these relative equal lows on Monday and reverse Monday, drawing back to a new week opening gap, and then going higher Tuesday, Wednesday, all right, or we consolidate, maybe make a run higher, and then we go down to those relative equal lows. This is the dollar with those relative equal lows. Now, the dollar has a sell side draw. I've been talking about relative equal lows here and how, last week we would maybe see an attempt to draw down towards these relative equal lows. And this sell side liquidity, once, if we're expecting the beginning of the week for the dollar to go down, it's going to be easier for the Nasdaq to go down, to go up, sorry. And it's going, or I should say, a better way of phrasing it is, if the dollar is going to go lower, it will be harder for the Nasdaq to go lower, which means we could see choppy price action. Once we've hit that sell side liquidity, if the Nasdaq is in a state where it wants to go lower, then we can expect the dollar, since it took sell side liquidity, to reverse and go higher, and that would give the Nasdaq a good opportunity to trade lower nicely. So that's something I was watching. Once we hit that sell side liquidity, is the Nasdaq in its state where it can go lower? And this is the bonds. I'm just reminding that this seems like it's the draw. If everyone is believing that interest rates are coming down in September, I think that we could attack these relative equal highs, and bond prices could be bought up, because if these rates are going to come down, everyone's buying bonds right now because they think that these high rates is like the last chance basically you can get these high rates, and they're buying them out. This is the 5-year contract, so they're buying out the 5-year as much as they can, is the way I see it. But there's relative equal lows. We are in a premium, so it's possible that we make a high here and we don't actually go back to these relative equal highs. But we've closed above that weekly inverse fair value gap. So I'm just looking at the weekly inverse fair value gap in the order flow here, and the fact that we're in premium. I actually have not checked. Uh, I have not checked the bonds to see where they closed this week. So we started to go lower. All right, and we have not dipped into that weekly inverse fair value gap. But yeah, just highlighting the premium, the equilibrium and the premium here, how we are in that premium, and just to be careful and watch if we start to see a retracement. All right, and pre 9:30, I might try to find a smaller market maker buy model to form this gap. This is before 9:30 on the dollar. I noticed this huge gap on the dollar. Okay, I want this to get filled this week. I also have a sell side draw. All right, so I want to see if, before we go to the sell side draw, if we fill this new week opening gap, I want to see a market maker buy model maybe run up to some short-term highs and then attack sell side, right? But oftentimes on Mondays we get a move lower before 9:30 to fill that new week opening gap, and then we start to move higher out of that new week opening gap, right? To create a market maker buy model, and this is the Nasdaq, the new week opening gap that was created. We already filled it. Okay, so let's see what I say here. It looks like we could get some accumulation around this new week opening gap. All right, I'm looking for accumulation there. And then Bitcoin, I just saw this chart. I think it's really nice. Potentially could make a run on the buy side. Bitcoin has a lot of relative equal highs, and this would create a market maker buy model. But I think a lot of people disagree with Bitcoin being like gold, but I'm starting to think more and more that Bitcoin will have the same dynamics as gold. Now, I know you can make the argument it doesn't compare to gold, but it's not about whether it compares to gold or not. It's about what do people think. And I think that especially the young generation thinks that it is comparable to gold. I mean, you can use it to make transactions in a split second and move money across the world and always have it on you without having to carry it around and show it off to everyone. Right? So that gives it value alone. And the fact that it has value, all you need is, do people believe that this is value? And I think a lot of people do. So if we are in a state where the markets might be putting in a top and there might be divergence with the Nasdaq leading lower while these other indexes are going higher, then you would want to see gold go up, which it did, and maybe Bitcoin, right? Again, Bitcoin's new, but I'm seeing higher prices on Bitcoin technically, and fundamentally, this could be lining up um, with that. But I'm studying this to just more so to find out more about the fundamentals behind Bitcoin and why people buy Bitcoin. So, post 9:30, price is showing a large wick on the daily chart. Bodies, however, are still climbing higher, but doing so slower and slower. And so we closed like a little bit of a long wick, maybe potentially leaving a high. Now I'm uncomfortable going higher here. Why? Because we are making these higher lows. And if you go down to an hourly chart, maybe a 4-hour chart, you'll probably see a bit of a trend resembling. So where's the liquidity? Well, people are going to be buying the trend on the smaller time frame, and liquidity is going to be lower, making it easier to slice through these things. Right? The fact that it's not exploding higher means it's not willing to go to that buy side liquidity. So I'm wary right now that we may get a bit of consolidation or a bit of weakness. And today really wasn't that nice. It kind of moved sideways and made a nice run lower in the afternoon. But watch Friday's high, how we hit Friday's high that previous day at around 9:30. Sort of like a Judas swing higher. And then quickly ran back down to completely balance out this range. Use that 15-minute gap as resistance. Run it down lower towards these relative equal lows. There was nothing really that I liked on that day, but I did see on this 1 hour, maybe 1 hour chart, yeah, this stop run. I did want to see if it had done an initial run higher, come down, meet the stop run beneath midnight open into this gap one more time, trade beneath these lows, and then start to go higher. The problem is that we didn't really close well beneath these lows. It just kind of wicked to them, leaving relative equal lows. But I would want to see Tuesday be very bullish to go to that buy side liquidity, and we'll come back to that. But the afternoon was quite nice. The afternoon we made an initial run higher, right, leaving this 5-minute fair value gap, which we used as support to go higher. So right away, if we've already left this gap open, right, you want to assume the order flow is bullish because these up close candles are being traded through and down close candles are acting as support. You don't want to see them start to fail. You want to see price be explosive and continue going higher. But we came back to that 15-minute inverse fair value gap, which, by the way, if you look at the price range on the left and the right is the first PD array you can use to find support, or sorry, resistance at. But the problem with this run here is we left a short-term high, made an initial attempt lower, and I remember trading this and thinking, I know there's some people that can frame shorts, right? I know there's some people framing shorts right now after fair value gaps it's leaving to continue this bearish price action. I'm only framing longs though, and so I knew it was high probability to go long, run up the short-term high, and then it dumped. Alright, this is the dollar. Oh, hold on. Before, was it? I think there was one more. Oh, 5%. Yeah, there you go. So this is the inverse fair value gap. When I was framing those shorts, I saw this gap act as an inverse. Price using it to go higher. Ran out that short-term high, and then we dumped lower in the last hour macro. And this is the market maker buy model on the dollar. So I just kind of described this. I made this a really nice picture and all. I dressed it up very nicely, but I said train your eye to see that stop run in the red shaded area stand out. This is a catalyst to forming every bullish PD array. So that run, that manipulation lower, right? Look at the bodies here and those bodies there. This manipulation is a catalyst to every single PD array, the breaker, the fair value gaps, the order block. This is the order block. And the explosiveness is going to form the order block, which is going to form the fair value gaps, which is going to form a market structure shift. That's basically the order block, the market structure shift that's taught in 2022 model. So you get that happen, and then Powell comes out at 12:30. It distorts price, really runs very quickly lower one more time to give smart money the opportunity to accumulate more longs. Don't be scared though. So where are the bodies? They're respecting that fair value gap. This is a high of the breaker, the highest up close candles of the whole breaker, and we use that as support inside new week opening gap. Lined up very nicely, running up above the initial consolidation. One deviation of that move lower on those short-term lows. That is target for the day. So that was a really nice market maker buy model. And then this is the price action. If you wanted to wait till 12:30 to trade, you had a pretty good entry after we sweeped all that liquidity and we came up, rebalanced this range, moved back into it. We created a short-term low, initial run higher, ran back beneath it, continued to run higher for the rest of the day. Alright, I'm back now inside. I had to put my Chromebook on the charger, but let's keep going with Tuesday. So before 9:30 on Tuesday, I wanted to see, well, price was beneath the midnight open, way beneath it. In fact, the midnight open was at the high. So I was really only considering longs. So this was at around 9 a.m. So I was only really considering longs to get back above midnight open and trade above liquidity. This news release manipulated lower into a fair value gap in discount and then ran way back up, now aiming for those highs. So there isn't really a good opportunity for me to get in. Bodies did not manipulate lower here, so I'm noticing how we, even though we wicked down here, we ran back lower to take out some people and to accumulate more longs. I still think that people think that there's going to be a lot of support on this trend, and the bodies overall that tell the story didn't really manipulate. So I'm wary of that, and so I'm not immediately thinking that we're going to run off and go higher. Also, dollars draw is higher, right? Because we have, like I said yesterday, before going that sell side liquidity, maybe we can see a high of the week. It seems like we're going to fill the new week opening gap and continue to buy side liquidity. Maybe the dollar wants to draw higher, and that would put downwards pressure on the indices. So there's a lot of reasons to go lower, basically. And after 9:30, Nasdaq is very slow, but the S&P was much better. Nasdaq is seems like it really wants to go lower. The S&P and the Dow are still going higher. Um, and I'll explain this on the next day, Wednesday. But the hourly chart view of the sell side liquidity I was watching, and this is after we ran up above this buy side liquidity. You know, there was those relative equal lows that Monday left that we did trade too. But first we needed to get back above midnight open and manipulate higher before going lower. Alright, so this is the draw I wanted to see this morning. It did occur, but I did not feel comfortable being in the market while the Dow was drawing higher. I am going to zoom into the candle that created the bearish order block in the afternoon. Price reversed after trading the higher time frame side level. So even though what happened today was not bad, and it was not a bad price action day. I mean, it made sense. The levels of liquidity it was drawing to. It did not look, great because the Dow was going higher. So as the Nasdaq went lower this day, the Dow went higher, and that's very low probability. I was taught not to trade in those conditions, and so I won't. Also, we're leaving, looking at the bodies, we're leaving relative equal highs at the bodies. That's something else to be wary of. But at the time, I don't think we're gonna really need to worry about those now. But at the time, I was worried about these right above midnight open and potentially Wednesday continuing a run higher above these relative equal bodies. A higher time frame was taken 9:30 due to swing. Price quickly range lowered to form a 15-minute order block. I could have looked for shorts inside this candle. Likewise, in the afternoon, price ran higher after making a low and reversing. This wasn't as pretty since we already ran buy side and sell side. Yeah, so I'm talking about how at the high here we ran out buy side, at the low here we ran out sell side. So in the afternoon, even though we have good price action, all it really does is it retraces into the range. So it's not that clean. It's not that nice. We get an initial run higher on that 15-minute, the 15-minute draw on liquidity as we form this higher time frame breaker. Then inside this breaker, we get the same thing but on a smaller time frame, which can be used to during the last hour macro. Actually, right before the last hour macro, but during the silver bullet hour at 2 o'clock to run up higher, inversing fair value gaps and bearish PD arrays to then consolidate above them. Now I think there's nothing really I like to see today at all on the afternoon or the morning. Which where do I show the morning? Let me just right here. There's nothing at all that I really like, and that I wanted to see at the time. This fair value gap resist price. Would I have shorted that fair value gap? I don't know, but I can tell you that I was thinking of it, and it never entered. So I don't know if I would have taken that trade or not. But and we get to Wednesday, and this was a pretty crazy day. I'm not gonna talk much about price here because all it did, and this is an hourly chart, is go lower, except for the last candle of the day. So it was pretty crazy, and the Dow only went higher. Right? If you look at a 4-hour chart, you see the Nasdaq dumping lower, S&P sort of dumping lower, but still a bit higher, and the Dow is absolutely going higher. All right, so this. Hold on, before huge junk lows sent down, getting long signals. I'm waiting to see if order flow will switch. Yeah, okay. So there's something going on here. Now there's different reasons why the Dow can be higher and the Nasdaq can be lower. Right? Some of the reasons could be because people expect interest rate hikes, and higher interest rates is bad for tech. Lower interest rates though is good for tech. Lower interest rates means that um, well, there's actually another reason, but obviously we're not in that scenario, so I don't know why I'm even talking about that, because people are only thinking that rates will go lower. So why would people, if rates would go lower, why would people be selling tech? That means that they can borrow more larger amounts with lower rates, and tech will be able to benefit more from that since they borrow money. And these safe companies don't borrow much money, right? These safe companies, these slower moving, safer companies, more sound companies that don't borrow much money, don't have much debt, right? These companies are mostly in the Dow, while the Nasdaq's mostly tech stocks. Now, the second reason is Trump, because of his the assassination attempt on him in the weekend. Now I believe that more and more people believe he's gonna win, and that he's a target, and if whoever assassinated Trump, the fact that they failed is just made him more popular and more favored. So if people believe Trump is gonna win now, they may be selling tech because they think that Trump is bad for tech. Um, there's certain comments that he said and things that he's done and said that would be bad for tech. I don't know why he's bad for tech. I don't really care, to be honest, because again, like I said, it's a seasonal tendency that it's going lower. I'm just explaining why the Dow would be going, why there would be divergence before a move lower. And the last reason is simply because people, and this is what I believe, people are moving their money from high risk assets like tech stocks and the Nasdaq to safer, lower risk assets, companies that are more sound, don't have much debt, who can weather a crisis better, that are in the Dow. And I think that the fact that there's this much divergence is what's going on. This is what happens every time there's a high put in, every time there's a low put in. Right? Money shifts from one index to the other, and this is what's happening here. The reason is why. And honestly, I'm only talking about why for fun because it interests me. It may interest other people. And for those that don't care, well, you probably already clicked off the video. Okay, so this yield curve, I'm going to try and explain it very briefly. But there's times where the yield curve goes beneath 0%. And what the yield curve is you take two bonds and you take the difference between them. Now I'm taking long-term bonds and comparing them to shorter-term bonds, like the 30-year to the 10-year on the first chart. The second chart has the 10-year to the 2-year, and the third chart has the 10-year to the 3-month yield. So these are percentages, which are the interest rates that these bonds pay you when you're holding them. Right, so if I give a loan to the government, if I lend money to the government borrows from me and gives in return gives me a bond or cash in form of a bond while I give them cash. And this bond has an interest rate. It's like a note. And at the end of that term, let's say it's 10 years, you give the note back to the government, and the government gives you what the note was worth initially with interest. All right, so these bonds oftentimes, when people believe that inflation is going to go up, they sell their bonds, their long-term bonds especially, and because they don't want to lose to inflation. If there's risks in the economy, they rather just be out of cash. So when they sell their bonds, there's an inverse relationship with the yields go up. And when you have the short-term bonds getting rolled over very quickly, because short term they think that the long term doesn't really matter that much, because in the next 30 years they probably don't care about what the short term fluctuations in interest rates are, but these 10-year bonds, 2-year bonds, 3-month bonds, they do care, right? So relative to the length of time, but especially in the 3-month and the 2-year, if you believe in the next 2 years rates are going to be higher, why would you hold on to a bond that's giving you an interest of 1%? Because if rates are going to be higher, inflation is going to be higher, and that would make you lose money. So people are going to sell these bonds, which is going to drive up the yield, making it more attractive to buyers, so that there can be liquidity for buyers to take out the sellers. And that way it may raise enough to the point where it's bigger than the long term, which gives that negative yield. So basically every time it goes into zero, something's going to happen, right? The smart money is expecting something to happen, something bad to happen, and they're getting ready to sell their short-term bonds, or they're selling their short-term bonds, making the long-term bonds giving a lower yield, a sort of belief that it's safer to lend long-term than short-term, which doesn't even make any sense. And every time it reinverts and goes back to normal, crisis happens. But first, you have the longer term ones, the 30 year to the 10-year, which inverts before anything else. You see, if you go back and look at the dates, you have that 30 to 10 year in like 2008. It inverts long before the 2008 crisis because the 10 year is still a bit long term, right? It's not the same as the 2 year or the 3 month. But we've already had these things inverted. The more important ones are the 10 year to the 2 year, which you can see is about to invert. It's getting close. Now, there's nothing saying that it can't go dip back down. It can't spend another year down underneath the 0%. But the fact that it's getting close and it's starting to rise, and we see that, if you look at the yields, they're exploding right now. If this momentum keeps going, we may get back above 0%. And the last one is a 10-year 3-month, which is precisely almost by within a quarter, oftentimes by the exact month, is going to predict these crises when they happen, when they burst, except for the stagflation, which was a bit different, and we're as low as we were in the stagflation, which means there's major problems going on. The stagflation was just one whole era, really. There wasn't just like one single crisis, it was a whole era. But we could be in for some serious shit if if we keep staying down here for a while. I mean, I don't know, this is a bit scary because we never had these things this inverted other than during the stagflation in the 1970s, which is very bad. All right, now Thursday, so it was a decent down close day to form the bearish fair value gap. Let me see how lower we went here, forming that fair value gap there. And most importantly, the Dow is starting to agree. And if you look at this price action that made a low in May, you want to look at the Nasdaq and the Dow together. The Nasdaq and the S&P only retraced about to where my mouse is. Compared to where the Dow went, it was a lot lower. And as the Dow was going lower, the Nasdaq was going higher. Now, as the Nasdaq's going lower, the Dow's going higher. And now it's starting to go lower, following the Nasdaq. And this is what I had for tomorrow. Should put this in a pre-9:30 for tomorrow. But yeah, market maker buy model. This did not happen, obviously, but what I wanted to see was the price overnight during Asia continued to expand higher off the afternoon, and that did not happen. Instead, London retraced deep into these lows. Asia consolidated, and so that kind of invalidated that idea, and it left buy side at London high. But that's for tomorrow. So this was a good day to short. Price created a bearish fair value gap after manipulating at 8:30 and saw a retracement into it before a big move lower. So where was the manipulation occurring? It was at 8:30. This run up above the short-term high here. That was manipulation, leaving a bearish fair value gap. Price comes in. When I was using this 15-minute inverse fair value gap throughout the morning, as the price was running up into this down close candles range that I'm highlighting with my mouse, and I was using that as an inverse fair value gap, which was balanced. Once price got above it, I kept it on my chart, and it referred to it very nicely. You also had the reclaim order block, which the bodies came and closed within. So afterwards, also new day opening gap. You can go from this high down to that low. Price goes back to a little bit of discount relative to the range just retracing in, and the new day opening gap resists price before sending it lower. So price is always going to gravitate that new day opening gap, and you see how we did not close beneath it. We did not fully balance it out, and so there might be a want to go back and close beneath it later in the day. Right, but 5-minute chart, I wasn't seeing anything. I knew that 9:30 would open up and probably continue going lower, but we would retrace first. So I was trying to long in that retracement to get back to a premium and higher time frame PD array. So this is what should have occurred in now after the fact was the SMT that was left. Once the Dow started to follow the Nasdaq, then you go for wait till it gives you shorting opportunities. It disrespects bullish fair value gaps, and then you short. and then down here. So I did take the second trade here on my Top Step account. But the first trade, and I did take this trade, but I got in a little too low. So this is what I did that day when I was trading my Apex accounts. The first one, I was going for a manipulation run up above that high. S&P did that, but not the Nasdaq. And I wanted it to, come back to a higher time frame, 15-minute bearish fair value gap. So I was up that time with over 20 points, and I was really like, it was almost a take profit, and I was kind of like in that high. Oh, that's a yawn. I was in like a high, an emotional state where I saw the money. I didn't take profit, and I wanted to see it run out that short term high. And now when it went lower, I'm like, oh, okay, this is a move lower. This is going to be a big move lower. I know it's going to work. And I re entered. The problem is I was very impatient re entering because I feared missing out on it. So I got in at a very low price, and price retraced all the way back up to a fair value gap, which I had my stop loss at because it was a 20-point stop loss. And that's like the most I hold trades for, 20 points, before I start to get really uncomfortable. And then price ran lower without me. And I didn't try to get back in, even though I could have. I didn't try and re-enter. I just let it happen. I said I already took a second trade. Even though I was right about reversing it, I just didn't want to continue chasing after it. Instead, I waited. I logged off the Apex account, and then I went to my Top Step and I started to trade that one. After a bit of time that I recomposed myself and came back, then I took that trade there. Right, so that was Thursday, and then we go to Friday. You see how Friday, right, price continued to go lower, disrespecting this price range. So before the day started, I wanted to see how price was willing to reach up into the relative equal highs and form market maker buy model. So this is something I was looking at. Now, notice the bodies down here, the higher bodies. We didn't really manipulate with the bodies, but the S&P did here, which could be SMT, and the Dow is completely lower. So until the Dow is showing me that it wants to start to agree, and then we can really see that really nice move higher where it's high probability. Alright, so until the Dow really starts to agree and starts to manipulate lower on these time frames, then I can't really frame a high probability low resistance move up to the highs. But what I would have wanted to see was just the Nasdaq continuous speed of that buy side liquidity, not really retracing much, but maybe like accumulating and manipulating up into the second stage of that run higher. And that did not happen. You see how Asia consolidated, London dipped lower. So when I got up, I was looking at these highs to form a market maker buy model with these highs, and no longer really paying attention too much to those highs. And price tried to get above them but failed. Notice how it is forming this idea of resistance, and this is going to house a lot of liquidity, so I wouldn't be surprised if we try and trade back to this area later next week. But this was a simple retracement on London range. It went up that much, right? Higher resistance, and though there was no news, so it created a lot of belief probably in this time that we were going to go higher, and instead found resistance on new day opening gap. Again, gravitates that very often. Every time we have new day opening gap, highlight it on your chart because price will use that a lot. And this is, wait, did I skip? Oh, these are the 15-minute levels I was looking at. So you have this gap, which I'm looking at this gap because it's the lowest fair value gap inside this down price range and this up price range. Then I'm also using the reclaimed order block. And so you see that 50% acts very nicely as resistance. Body staying underneath 50% of the reclaimed order block and continue to drive lower throughout the day. So we had good price action actually Friday. And I did again try and trade Friday, and I did work out. I took a long inside this gap ahead of 9:30 because I was going to be packing that day at 9:30. We were going to be loading a truck, and so I was literally busy all day. That's why I'm very tired today because and sore from yesterday. But we left a lot of low resistance liquidity and sliced right through that to continue higher. All right, basically we're retracing into London range, so I only assumed higher price action and a 9:30 reversal. It was like a trade that I was taking based on time. We would go higher until around 8:30 or 9:30. I'm not considering 8:30 because there's no news, but 9:30 is when you're likely to see, because of an open, you're likely to see some manipulation which would lead to a reversal. Until then, it's just a continuation towards new day opening gap. So I could have held this trade from here to the new day opening gap, but I only held it for, the 12, 13, it was around 13 and a quarter points. And then it ran up there towards new day opening gap. All right, this is the 9:30 open. You see the manipulation, the accumulation first, and then we manipulate lower into some bullish PD array. We run back higher to attempt the London highs, hit the midnight open, right? Most importantly, hit the midnight open, fill that new day opening gap one more time, wick back beneath it, and sweep those relative equal highs at the high of the consolidation. Then we get a run lower. So now these executions are just on a paper account, but you have this yellow accumulation, we manipulate beneath it and we manipulate above it. I want to then see shorts, but you see, if you tried to go short here, you had been holding and you had a day trade, you'd been holding for a very long time. Now why is that? Well, because if you look at the Dow and the Nasdaq, the Nasdaq initially going higher, the Dow initially going lower ahead of that 9:30 open. And I marked 1016, which is when it starts to make that move lower. So you can see how the Dow has been going lower, and Nasdaq was consolidating in that yellow area. This is showing that the Dow is leading at that time, which is why the Nasdaq ran up higher than the Dow. It was leading higher. But which one went lower throughout the rest of the day? Obviously the Nasdaq. You can see it made a low there, further beneath this short-term low in the 5-minute fair value gap, and then it continued on to make an even lower low here, right after which it did there. Then the Dow made relative equal lows at the end of the day, and then the Nasdaq made even lower lows at the end of the day. So the Nasdaq was a lot more bearish and it led lower, but before it led lower, it needed to consolidate so that the Dow could get back in sync in terms of where your equilibrium is. It could get back in sync with the Nasdaq, and then it went lower because the Nasdaq leads. So money needs needs a bit of time to shift from the Dow to the Nasdaq in order to make the move. And if you don't see the Dow lead, I just don't trade. Sorry, I mean, if you don't see the Dow follow, I just don't trade. So this is why I didn't really like shorts, because initially the Dow was following, and I couldn't really tell you, how much time we would be. Maybe you just use the macro times in that case, but I couldn't tell you, how much time it would be before the Dow would sync with the Nasdaq and it would actually start to see low resistance liquidity lower. But I think back here, once the Dow actually starts to follow the Nasdaq, I think back here would have been nice this second time around as it comes back to the 15-minute PD right here after accumulating. It accumulated down here, ran up higher, and then inverse fair value gap. You could have looked for shorts there to run down that sell side liquidity. All right, so that's it for the weekly review. Thank you very much and have a good day.